2022 is a more complex year, so I can't assign as high a probability to it. My perspective is, in a world riddled with debt and overwhelmed by debt, if you raise prices on people, they will consume less. What people need to understand is asking me for a snapshot in time is not my prediction that I'm actually investing on, because what everybody forgets to do on Twitter is ask, what is your time horizon? Does it matter that it goes to 200,000 by end of year or not? No, because that's not my time horizon. My time horizon is, I'm thinking of this space over the next 5 years. Where does it go? Are there markers on the way? Yes.
Macro investor Raoul Pal, in his final interview of the year, shares where he thinks the crypto market is at and what he expects for Bitcoin and Ethereum in 2022. Raoul stuck his neck out earlier in the year and gave a year-end prediction for Bitcoin of $200,000 and Ethereum to get to between $20,000 and $40,000. In this video, Raoul explains why these predictions didn't turn out and also why he is now looking towards January for a big institutional allocation towards crypto. Make sure to stick around to the end of the video where I will cover Raoul's most recent Twitter analysis on how institutions are now controlling the market and why we have had a dampened Q4. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
So my view is the opposite of everybody else's view currently. My view is that growth slows dramatically based on both the central bank balance sheet tapering and the higher prices of input costs like electricity. Those kind of things. And also gasoline for cars. Those kind of things are fixed costs. And if you rise the fixed costs in people without raising wages as much, you end up with less demand. Or its potential is more borrowing. That's the only way. You either consume less or borrow more. It doesn't look like the banking system really wants to lend in that way. And household balance sheets are already, have an excessive amount of debt. So I think the balance of probabilities is a slower year, which is not what people expect. A slower year would tend to see a reduction in the rate of inflation, a reduction in bond yields, and a probable return of expansion of the central bank balance sheets, which is somewhat typical after almost every single recession. The central banks tend to wait for the economy to truly stabilize. And that process usually takes about 2 years of further rate cuts as the stimulus rolls off and then the economy comes down to a trend rate of growth, which is too low. They stimulate again, it drifts down, they stimulate again, and eventually you find the equilibrium level of the trend rate of growth, which I think is much lower than people expect. Most people see what's in front of their eyes and not what lies into the future. So you need to look at the kind of probabilistic trees of, okay, what could happen? There are no certainties. None of us know, but where do the probabilities align themselves? Most people look with inflation up now, therefore inflation. Therefore wages will go up. And and therefore the Fed needs to tighten. That's the general how the market tends to think. The macro game is all about living in the future and looking backwards at the probabilities to say, what is the most likely outcome from here? And is there opportunity to invest accordingly?
So you think that the inflation rate of like almost 7% that we've seen in the US will go down?
Correct. Either mathematically it's likely to go down. If you also just step back and say, well, what has happened to the price of oil? It's been coming off again. Copper hasn't gone up for some time. Lumber prices, well, they've come down. So what we're left with is natural gas in Europe is still very strong.
Yep.
Some of the agricultural complex is still strong because of supply issues. Those are the real issues here. I think we're already starting to see mitigation within housing prices and stuff like that, where prices, again, destroyed demand.
So from a selfish, let's say, crypto perspective, what should we want from 2022?
From what we want and what we get is always two different things.
Obviously.
The best backdrop to crypto would be further economic weakness and the marginal propensity for the balance sheets of the central banks to increase. That would be positive crypto and would certainly extend the cycle further than people imagine. And that's potentially on offer here, but it's far from a certainty. I never speak in terms of certainties. So why did I have that projection of Bitcoin? It wasn't an emotional projection. It's like, okay, Bitcoin is following very similar past patterns to 2013, 2017. So we have a contextualized understanding. We can put it within the logarithmic trend, and it would extrapolate being about one standard deviation overbought at around those levels, and that would be correct with the trend. We also know that it's trading probably below Metcalfe's law fair market value right now. And we also have observed in the past that the last quarter tends to be quite strong. In fact, very strong. So the balance of probabilities are that you're going to have a good run. Is that a certainty? Far from it. Does that make me want to increase my position? Well, I've been increasing it ongoing anyway. So it didn't change my framework. My framework is not about the end of the year, what price it hit. That's nonsense. That's a thing of podcasts because it gets headlines.
Why do you answer then? Because when Pump asked you, I was like so sure that you will not answer.
Because I want to express the honest thing of, okay, this is what I think is most likely to happen. And I think it helps people contextualize certain things. And yes, I can be wrong, and I've always said this. I've also noted that the market has a tendency for maximum pain, which I've talked about in other podcasts. And maximum pain is we all believe one thing, then the opposite is likely to happen. And I step back and look at it and think, who is the marginal driver of this market right now? It is not retail. Why not? The wallet addresses, new wallet addresses and stuff are below highs now. And I think it's to do with this consumption issue. You've raised prices on retail in terms of fuel, energy, fixed costs. So their marginal ability to invest has gone down as well as to consume. So you've taken marginal money out of the market. So if you've taken them out a bit, and then the institutions are at the year end and they're incentivized differently, again, they're not saying they don't believe in the market. They're saying, I believe in getting paid. And so I want to protect my profits. I get it. It created a lopsided market. Now, the question is, are they done? It looks like they're done because the market has been kind of just chopping around since last week, which was the traditional last week of everybody squaring their books. Could it have another leg lower, potentially? Could that come out of Asia, which is where a lot of the selling has also come from? Again, possibly. But the probability is that next year ends up being a strong start, just because capital gets put to work. You can manipulate the market in the short term. You can't do it in the long term. So I'm not a short-term player. I hear people talking about what the whales are doing, what people are doing in Asia, what some of the the bigger trading people in Asia are doing. And sure, I mean, humans are incentivized to manipulate markets. But in my time horizon, it doesn't matter. In the short term.
In the short term,
I think all markets are manipulated in the short term in some way, shape, or form. Crypto just happens to have this 24-hour but not 24-hour liquidity. And that creates a opportunity set for people who want to move the market around for specific things. I know this from the derivative market. You would see if there was a option was expiring at one point, people would try and expire it at that point to make it worthless or valuable, whatever it was doing. Same with program trades where you'd buy huge baskets for a pension fund. They would guarantee a price into the close and they would manipulate the price. We've seen it in LIBOR. We've seen it in the foreign exchange fixings. We've seen it in everything. If there's an economic incentive to do it, humans will take it. It's actually not all in Ethereum. It's about 80% Ethereum. There's 95% in crypto because I've also got a position in carbon. which is the only other non-crypto trade I've got. But the other layer ones, it's really simple to me. I don't know why everybody gets in a big mess about this. It's really simple. So Bitcoin is the least flexible in its current format. So if you want flexibility of smart contracts and ease of use, you go to Ethereum. That's great. Now, if you want cheaper fees or faster, you go to another layer one, Solana, Terra, Avalanche, etc. And they all have their place in the ecosystem. And that's fine. And it's not, I don't think the market is all about price or speed. It's all about network effects. Those chains are getting network effects. And I think Ethereum's dominance of the alternatives market, the non-Bitcoin market, will fall over time. Because the market's going to broaden out and find different use cases. It's like I was having an argument on Twitter last night about decentralization. But it's not decentralized enough for them. Nothing is compared to Bitcoin. But people will take trade-offs. Everybody does. Life is about a trade-off. And the trade-off is less decentralized equals faster and cheaper. And that equation is what it is, and you make your choice. And that means there will be people adopting some of these ecosystems. The value of all of the mobile phone networks in the world is worth a lot more than gold. But nobody compares them. That's stupid. But people compare these things. Now, if in 10 years' time Bitcoin has smart contracts, has cheap transactions, all of these things that Ethereum offers, then fine, that may change again. I don't think of it necessarily as a permanent flippening. Maybe something else happens. I have a completely open mind. But right now, if you look at the network effects and the speed of growth of the network, Ethereum will outperform. And eventually, it only has to outperform by 2x, and it's done. And it's larger. Does that mean that Ethereum's won? No. They're two different things. It's ridiculous.
So there is Raoul on why his price predictions didn't turn out and what his broader outlook is for 2022. Now, Raoul also expanded on these points in a lengthy Twitter thread. I'll cover the main points he broke down, but if you want to read the thread in its entirety, I'll leave links in the description. Raoul begins with, there is a lot going on in the digital asset space, but also nothing going on, and that is the problem. Let me give you some thoughts. BTC volumes have been stagnant since the run-up in 2020, and active wallet addresses have not gone anywhere either. It seems that retail activity peaked at the beginning of 2021, but that has been replaced by institutions, here measured by wallets with over 10 million, which are rising in general, but the numbers are still pretty small. If Metcalfe's law applies, the network growth is currently very slow, hence why the price is sluggish. The same is true of ETH, but there is different factors at play here, hence the outperformance. My view is that the key reason the market has seen less retail activity is that wages are rising slower than CPI. The cost of living has gone up dramatically, and that has removed the marginal investor from crypto. They just can't afford the disposable income. I don't see stable economic growth and lower inflation for a while, so we are going to have to rely on institutions and hedge funds to allocate meaningful capital. I think that is coming, and Q1 should confirm that, indeed maybe January, but we have to wait and see. New capital will flow in over time, and a broader rally, when it arrives, will bring retail investors and a reflective loop of institutional investors FOMOing in. That day will come. You just have to not overextend yourself, don't use leverage, and sit tight. Play the long game. Thinking more on this, we are still digesting a large loss of active wallets from China, and non-China growth therefore needs to exceed that loss of accounts for network to regrow too, likely a matter of time. The best advice I got was from Paul Tudor Jones, who once told me the best investors he knew are those whose investment time horizon matches their idea time horizon. If your model is based on Metcalfe's law for all DAs, then you need to be thinking in years, not weeks or months. So there is Raoul with a more in-depth breakdown of why we are seeing such a damn Q4 for crypto. In a nutshell, keep in mind the big picture thesis and remember to be thinking long-term time horizons. Do you think he's got it right? Let me know in the comments. Anyway guys, hope that breakdown provided you all with some value. I'll see you all in the next video, and as always, have a great day.